stop for a moment. Are you tired of your stop loss getting hit just to see the market reverse back up? What if I told you there's a trading strategy that protects your trades without using stop losses? It's called hedge trading and it can help you make money. But alright, so before we can start hedge trading, we of course first need to know what is a hedge in the first place. And in very simple terms, a hedge is a form of risk management tool. You can think of it a little bit like an insurance for your trades. And it often involves taking an opposite or offsetting position to reduce losses if your main trade go against you. So let's say you go long on Bitcoin because you believe that Bitcoin will go up. What hedging basically does is that if Bitcoin goes down, this hedge will actually make you some money even if Bitcoin goes down. And it can be a very useful tool to reduce risk and even make some money even if your main position is in the opposite direction. So just like a stop loss, hedging is not really meant to increase your profits, at least not directly, but it's more designed to limit your losses. But here, and this is very important, if you want to make lots of money in the long term, I would say that it's pretty much more important to limit the downside than maximizing the upside. So learning about hedges is a very useful tool. But now then, what is a hedge trading strategy? Well, a hedge trading strategy is simply a plan that protects your portfolio using hedges. And here, I feel like when it comes to hedge trading, many people are overcomplicated, but the sort of main portion of hedge trading is pretty simple. What you do is that you stay in your main position, as I said, like holding Bitcoin, stock, or anything really, while using another trade at the same time to balance risk. And later on in this video, I will actually show you guys a tool that you can use to copy other smart money traders, other hedge funds, and so on and so on. So make sure to stay tuned for that. But the goal, as I said, is to make your portfolio stable, especially during volatile times. So think, for example, when the stock market crashed after the tariffs, that, looking back, that would have been a perfect example of where you could have hedged your bets. But alright, so now let's take a look at the main difference between hedging versus stop losses. First of all, let's take a look at hedging here. As we have been talking about, it keeps your position open while reducing the risk. That is one good thing about hedging, that, if you set a stop loss, you will get stopped out and completely out of the position if the market goes down and hit your stop loss. But hedging is better in a little bit longer term scenario. For example, if you think that Bitcoin will go up in the long term, but in the short term, you might actually think that Bitcoin will be unstable and maybe even go down. This can be a great time to consider hedging. Because as I said, it protects against temporary market moves, so it's more a protection against short-term money move. And one downside is that it can cost to maintain. You have to pay fees and spreads and so on. One upside though is that it's more flexible, so you can adjust or remove a hedge anytime. And as I already mentioned as well, it's better for long-term positions. So hedging can many times be better in long-term, while stop losses can many times be better in short-term. But let's take a closer look at stop losses as well. So a stop loss closes your position entirely at a set price. So you might, let's say that you are trading something that is at 110, you might set a stop loss at 100, and then if the price goes down and hit your stop loss, you will automatically sell, so you will no longer be in the position. So this can be very useful in many situations to get this hard protection against loss. It's free to set, it doesn't have any ongoing cost. That is a good thing That's a good thing with stop losses. But you can, one thing that is the downside here is that you can get stopped out temporarily. So you might have experienced this, as I show you guys in the intro. Many times it feels like, you know, the market goes down, hit your stop loss, used to immediately reverse. And that is actually a very common trading strategy. I do have a video about liquidity. I highly recommend to check that one out if you want to learn more about how some traders actually take advantage of other people's stop losses. Definitely, guys, check out that video. But here, it's many times better for short-term trades to use the stop loss. And one pro tip here is to use stop losses for trades where that you are less confident about, or shorter term trades. And hedging is more longer term investments. You want to hold long term, but you want protection during volatile times. And I can also just mention, if you want to learn more about stop losses and risk management in general, risk management is one of the most important parts of trading. It might even be the most important part. I do have a full video about risk management as well, and I will make sure to link it in the video card as well as the description below. But alright, so now I want to quickly move into TradingView right here. If you don't know, if you're new here, TradingView is the platform I use for all my trading, technical analysis, and even for all my investing and fundamental analysis as well. It's a great platform, and if you haven't got started with TradingView yet, I do have a special link you can use. You can get 30 days free TradingView Premium and also a $15 bonus. So make sure to check that link out. But now I want to show you one use case, one real life use case of hedging. So here we're looking at NASDAQ, so the US stock market, you know, very heavy on tech. And you can see that this period right here was the, you know, very volatile period where the market basically crashed because of Trump's Liberation Day and tariffs and so on and so on. And this is a scenario where, you know, you could definitely have used a hedge. So let's say that your overall portfolio, let's say that you are long stocks. So you might, you know, hold like a NASDAQ ETF or S&P 500 ETF. ETFs is basically a way to get exposure to the whole market at the same time in a very nice and easy way. I do have a video about ETFs. So if you want to learn more about it, definitely feel free to check it out. But let's say that you think the stock market in general will go up. But because of the recent tariffs, you think that in the short term, I believe that the market will actually go down. So this is a scenario where you can hedge. So you hold your normal position, so you are still long stocks, but you buy a hedge, like for example, a short ETF or some other kind of derivative that makes you short the market because you are worried about tariffs. So let's say I think the Liberation Day was around here and you was like, I expect the market to go down a bit more, but I don't want to sell my long-term position. Then you can enter a hedge right here. And what this hedge will do is that, yes, because you are owning stocks, your portfolio will go down a bit when the market goes down. But because you own a hedge, your portfolio will not go down as much as the market. So let's say that instead of dropping all the way down here, your portfolio only drops a little bit like this. And then if you sell your hedge correctly, let's say you sell your hedge down there, then you will see that your portfolio would have actually outperformed the market. It would have dipped, but it would have performed better than the market in general. So this is one use case of, this is one of the main use cases of hedges. You expect the market to go down, but you don't want to, you know, sell all your long-term investment. That is a great way to use a hedge. But right, okay, so now let's switch attention because I want to show you guys a super powerful tool. This tool right here is called InvestingPro. It is a paid tool, but don't worry because I do have a special link. The link will be both in the top comment of this video as well as the description. And you can use that link to get a total, I think right now it's a total of 65% discount because InvestingPro do have a summer sale, and you know, everyone in our community will get $15 extra on top of the summer sale. But it is a paid tool, but feel free to follow along or check out the link down below. But one of many things you can use this tool for, it has, you know, AI trading strategies, it has an AI chatbot. By the way, I can just give a shout out to their IT15 trading strategy, which has a return of, as you can see, 2,300%. I also have a video about InvestingPro if you want to learn more about it. But in this video, I want to focus on the Ideas tab, because if you click on the Ideas tab right here and you scroll down, you can see that we can actually select hedge funds right here. And this is a way for us to see what are some of the best smart money traders and investors doing right now. So one very famous hedge fund founder is Ray Dalio. So what we can do is that we can simply press on Ray Dalio, and here we can see everything Ray Dalio is holding. So what is Ray Dalio trading right now? We can get a nice breakdown of the sectors. You can scroll down here, you can see all the positions. Maybe I'm not allowed to, to reveal all of them, but as you can see, we can basically track any hedge fund right here. So we have Ray Dalio, Scott Ferguson, Nelson Peltz. You can see how their return looks like, and so on and so on. And this is basically the goal of hedge funds. They want to beat markets even in sort of bad times. But right, so now let's switch attention and take a look at some beginner-friendly hedging strategies. And the first and most simple hedge trading strategy is to short sell. This is what is called a direct hedge. And this is to simply open a short position against your long trade. So example, if you're long Bitcoin, you can open a short on, for example, Bitcoin futures, or short Bitcoin directly. If you're looking for a platform to short, you can use Bybit, for example. I do have a special link that you can use to sign up for Bybit, and the more the trade, the more bonus you will get. You can get a total of $30,000 in bonus, but do be aware that most traders will get $100. But if you want to get, you know, $100 in bonus for crypto trading, make sure to check out Bybit. And here it works for crypto, stocks, forex. And as I said, many platforms like Binance, TradingView, even Bybit support shorting. Another classic is something called diversification. This is something you have heard about if you are investing, and this is simply to spread your risk by owning different assets. And it's important that these assets are not correlated, because if they are correlated, this basically means that the assets tend to move in the same direction, and then the risk, they are often not perfectly correlated, but the more uncorrelated they are, the more, you know, real diversification you get. So if one asset drops, another asset might rise. And we actually have a TradingView indicator for this that I will show you guys very soon. But here, this is not a direct hedge. This is a more foundational risk reducing method. We do have some other hedge trading strategies as well, but I don't have time to cover them all in this video. So let's actually jump right here to some tools. One tool here is, we do have many TradingView tools that we can use for hedging. One is known as the correlation coefficient. So let's jump back here into TradingView. If you want to open the correlation coefficient, you simply go up to indicators tab here and you search for correlation coefficient right here. You can see we have multiple built-in ones, and we also have multiple indicators created by the community. But I'm going to open up the simple correlation coefficient. And what this indicator does is that you need to choose another asset to compare the current asset with. So remember, right now we're looking at NASDAQ 100. And let's actually see how gold compares with NASDAQ. Are they moving in the same direction, or are they moving in the opposite direction? So here you can press apply. And what the correlation coefficient tells us is, let's actually add gold to the chart as well, so you can see it more clearly. Let's add XAUUSD. That is the ticker for gold. And as you can see here in the bottom, we have the correlation coefficient. And what this one basically tells us, let me actually make it a bit more clear here, a bit thicker line, is that the closer this line is to 1, the closer gold and NASDAQ moves in the same direction. So for example, right here, you can see that we have a value close to 1. And as we can see, during this period, gold and NASDAQ moved in the exact same direction. And for example, if we look here, where the correlation coefficient is close to -1, this means that they move in the opposite direction. And you can see that during this time, gold went up, but the stock market crashed. So if you want to have real diversification, you want to preferably find assets that, you know, moves in opposite direction, but because they can offset each other. So this is a useful way. You can use the correlation coefficient. You can try to find assets that move in the opposite direction. And this is one way to indirectly hedge. But right, so now when you know about hedging, it's super important to continue learning about risk management. So when you have the time, I highly recommend to check out this video about risk management next.